Good morning, everyone. In this case, from Zurich, we have today Grace Blakeley, an English economics and politics commentator, who has written a very thrilling book about Corona crash, how the pandemic will change capitalism, as a guest. I am your host for the day. And I'm very happy to do so. I'm based in Zurich, in Switzerland, and you see my details here. As usually, we would like to thank our generous sponsors, which you see now here, which go through a wide array of fields across technology, economics, and finance. And without their generous support, these kind of events couldn't be possible. I will just give the floor to Grace, who is waiting, but I would like to add some housekeeping notes. As you know, there is a chat function here on the screen. Please use that and enter your questions, which I will later moderate and ask Grace to answer. You know that there will be an upload of what we've done today, and the presentation can be downloaded as well. But in this case, I heard from Grace that she is good enough to speak without notes and slides. So we will have to focus on what she has to say. Now, in this case, again, I hope you enjoy. Welcome to Grace, and the floor is yours. Thank you for being with us.
Thank you so much, Ariel, and thank you for having me. I think that's the first time anyone's described my book as thrilling. So I will take that as a compliment. I hope it was a page turner. Yes, so today I want to talk to all of you about my book, The Corona Crash, and talk a little bit, I suppose, about some of the quite broad trends that I think we'll be seeing, or that already are kind of taking place within global capitalism, partly as a result of the COVID-19 pandemic itself, and partly as a result of some pre-existing trends that I also want to talk a little bit about today. I'm going to try and be quite succinct because we don't have that much time. So yeah, please do, if you have any questions, just keep them, put them in the chat function or keep them to the end. So in the book, I kind of look at where we were before this crisis began. Now, we went into the COVID-19 pandemic with a relatively weak economy. If those of you who have the capacity to can think back to 2019, I was at the time writing for the New Statesman, and I had a cover piece, I think it was either in 2018 or 2019, basically looking at what the next recession might look like. There were lots of murmurs at the time that we were reaching the kind of the peak of the recovery, and that we would at some point be looking at another recession of one kind or another, whether that would be catalyzed by a trade war, by a debt crisis, or by some other external event. Actually, it ended up being the COVID-19 pandemic, which was dramatically more significant in terms of economic outcomes than any of those other factors might have been. But it's worth just looking back and thinking at what the economy was like before the pandemic hit. Globally speaking, we had this problem, which we continue to have today, of extremely high levels of debt, and now debt being not primarily actually this question of sovereign debt, of public debt, which is tends to be what mainstream media focuses on when we discuss this question of debt, but actually household and corporate debt. So in the US, for example, prior to the pandemic, we were already seeing lots of people discuss this idea of a kind of corporate debt bubble, lots and lots of cash going into high yield corporate debt in the US. In China, there's been this long-standing problem of basically, Chinese state-owned corporations whose lenders are predominantly state-owned banks, many of them being effectively insolvent, and those loans just being rolled over under the direction of the Chinese state. There were lots of questions around household debt in some advanced economies that perhaps hadn't had the same kind of boom bubble dynamics that we saw in the US and the UK around capital inflows, house prices, and consumer debt. So places like Australia, New Zealand, Canada, some of the Nordic countries, consumer debt being quite high in those places, and sovereign debt in some of the states in the global south in particular. So there were already concerns around that before the pandemic hit. And naturally, many of those challenges burst out into the open during the COVID-19 pandemic. And at the start of 2020, the big question that was being asked was, right, how are all of these economic actors going to be able to sustain their obligations to creditors. And what we had in the end was central banks stepping in and basically saying, we're not really going to allow anyone to default effectively. And kind of becoming a backstop for almost the entire economy, where we've seen states step in and become backstops for the financial sector after 2008. During the COVID-19 pandemic, we saw states step in and become a backstop for the entire economy. But debt wasn't really the only problem, and in many ways it was a kind of reflection of some much more profound underlying challenges. So we'd seen a lot of economists come out and say after the financial crisis, we've got this problem of secular stagnation, secular meaning long term. And so a few economists were basically saying, if you look at particularly productivity, then you'll see that there's a long-term kind of stagnation in rates of productivity, so in basically output per hour worked across most advanced economies. And that's also being reflected by lower wages. So in the UK, for example, we had the longest period of wage stagnation since the Napoleonic Wars. In the 10 years following the financial crisis. In the US in 2018, the average worker was as well off in purchasing power parity terms as they'd been in 1979. So that's an astonishing period of effectively no growth in living standards. And alongside that, we had relatively high levels of inequality, and inequality that we now know had risen in the UK and the US and some other economies after the financial crisis. And that was both income inequality and wealth inequality, but also some of these other issues that have become really politically salient. So regional inequality, gender inequality, racial inequality, all of these things had been rising. And together, some of those trends like inequality, for example, aren't generally lumped into this idea of secular stagnation, but certainly productivity and wage stagnation, effectively the idea that lower than zero interest rates, central bank interest rates, would be required to maintain the non-accelerating inflation rate of unemployment. So basically to kind of keep all the resources in the economy used at capacity, which is obviously a real problem for central bankers. It also suggests a kind of general lack of dynamism within the economy as a whole. And on top of all of that, we have this massive looming threat of climate breakdown, which was just really starting to kind of push into the political agenda and the collective consciousness prior to COVID-19. And I think now has become, it is frequently ranked as the most important issue for voters, and is obviously, a central consideration for policymakers, particularly those in areas where we're already starting to see the impact of climate breakdown, whether that's the US or India or China or parts of sub-Saharan Africa. So we already had all these issues going into the pandemic. The pandemic hit. We saw drastic action taken by central banks all over the world in particular, but also by states, by treasuries. You had furlough schemes. You had lots of facilities made available for example, dealing with people's mortgage debt. You had lots of loans and grants made available to businesses. For big businesses, you had special facilities set up within central banks to allow them to roll over their debts. And at the global level, you've had a moratorium on sovereign debt for some of the poorest countries in the global south, as well as things like the issuance of new special drawing rights from the IMF and other mechanisms to try and make sure that the debt crisis that's afflicting the global south doesn't get much worse. And yet, despite all of this, many of the issues that we saw before the crisis are actually going to get worse after. So let's take this question of income and wealth inequality. And part of the reason that many of these trends are going to get worse is actually because of the actions of central banks. So let's take this question of income and wealth inequality. I don't think it's now controversial to state that, before COVID-19, the massive asset purchasing programs undertaken by central banks had first really pushed investors to reach for yield and created some questions around financial instability, but also perhaps more pertinently had pushed up asset prices. Now, there's obviously a live question as to the overall impact of loose monetary policy on wealth inequality. Does the kind of impact on demand mitigate the impact on asset prices? It's very difficult to say, but we do know that, central banks' actions have had a massive impact in terms of asset prices across the board. And I think it's kind of colloquially understood now within the finance sector, and I mean, you guys can tell me if I'm wrong, but the central bank policy is basically going to be the biggest determinant in terms of shaping the overall trends within, for example, equity markets over the next several years. And that's a pretty substantial shift in terms of, not just the way that central banks work, but also kind of the nature of capitalism. The idea that the long-term interest rate is now a policy variable is quite a substantial shift in the thinking that underlies central banking. But it's also generating these pressures of asset price inflation, which again has implications for financial stability, but also for inequality, because assets are in most economies unequally distributed. In some economies, they're much more unequally distributed than others. So when you see, a long increase in equity prices, when you see long-term increases in house prices, that creates bigger gaps, both between people who own stuff and people who don't, but also between different parts of the country. So asset ownership is obviously concentrated in the UK and the South, and other parts is concentrated in the wealthier areas of the country, and between genders and races. So in the US, for example, there's a massive racial wealth gap. So that's going to kind of continue to inflame those tensions. In terms of those other issues around productivity and wages, again, we're not seeing any kind of real long-term thinking about how to solve those challenges. I mean, there's lots of kind of questions about where the productivity puzzle comes from. Some people say it's to do with the rate of technological change. Some people say it's to do with demographic aging. But I don't think there's any real disagreement that a big part of that problem has been very low rates of both public and private investment over the long term. Well, really since the financial crisis, actually. And even before the financial crisis, a lot of the investment that was taking place was concentrated in kind of financial and professional services, and therefore, was basically illusory. So that question of how to kind of push private investment, and also how to get states to undertake a good amount of public investment, maybe to crowd in some of that private investment, is still live. And again, that comes back to this question of what central banks are doing in response to this crisis, because what would you do to try and increase investment if you're a central bank? Generally, you would cut interest rates. But we've reached this point really where obviously interest rates can't go any lower, and where asset purchases and tax cuts don't appear to have had much of an impact on private investment. If you look at the Trump tax cuts, for example, they were basically plowed into share buybacks, dividend payments, and just really accelerated this boom in asset prices and in equities that we'd seen already. And a big part of that challenge is, again, it's kind of this self-reinforcing cycle of businesses. You can make credit as cheap as possible. If they don't see opportunities for investment, they're not going to invest. And what creates opportunities for investment? Well, it's demand in general in the economy, and what is a significant factor influencing demand, not only private investment but also consumer demand. What's a factor influencing consumer demand? Employment. What's a factor influencing employment? Investment. So you have this kind of cycle which has been problematic for quite some time now, and really does require something significant to try and shift it. So as well as those problems, you also have ongoing question of what to do about climate breakdown. You have a mounting debt crisis in the global south. So obviously, when the pandemic hit, you had the biggest outflow of capital from the global south ever recorded, bigger even than the debt crisis in the 1980s. And that is something that still hasn't been resolved. We have this moratorium that's going to last until the end of the year, but we don't know what's going to happen after that. And another challenge, which is increasingly live, is this question of monopoly power. And this links to all of these other problems, actually, because when you have a really, when you have markets that are very, very concentrated, when you have a few companies with a lot of market power, we focus on the impact that has on prices, but it actually has a lot of other impacts as well. So these companies are often monopsonies, so they have their labour market monopsonies, so they're able to push down wages. They often have a huge amount of political power. We see this with, for example, Amazon and its relationships with local and municipal and national governments. They're also often less innovative and less likely actually to invest. Obviously, this is the nature of monopoly, means you slow investment, you reduce investment in order to keep prices higher. So we have a lot of evidence that monopolies are actually kind of less innovative on average. They're, we know this with a lot of the big tech monopolies because they're sitting on these massive piles of cash and have been for some time now. So monopoly power is another one of those questions that we're going to have to deal with. Now, in response, a kind of progressive person, someone on the left might come back and say, right, okay, well, the state needs to do something about this. But what we've seen over the course of the pandemic is actually, the state is back. This idea that we need to kind of shrink the size of the state, which was always a bit of a misnomer, because what was happening during the neoliberal period, during the period of austerity as well, was less a shrinking of the state per se, and more of a reorientation of the way that state power was used. So away from supporting the vulnerable and towards actually supporting the wealthy. So what we have at the moment in a lot of economies is a substantial amount of welfare for the rich, of corporate welfare, and that's really been exacerbated over the course of the COVID-19 pandemic. And I think this shows us a much bigger and more general problem, which is that the capitalist state, as a Marxist I would refer to it, is not really any solution to the problems that we're facing, because state policy is determined by very similar interests as those that are powerful within the private sector. And, just anecdotally, we've seen this very, very clearly during the pandemic, both in terms of the amount of money that's been distributed to private corporations without really any checks and balances whatsoever, but also in terms of the frequent corruption scandals that we've seen, particularly in the UK. So whether that's, the Greensill scandal and the very, very close links that existed between Lex Greensill and the Conservative Party, whether it's all these questions around Boris Johnson's refurbishing its home, whether it's around the chairman of the Conservative Party, corruption scandal after corruption scandal after corruption scandal. And it really does just show this challenge of how are we supposed to fix any of these problems when the politicians who are supposed to be acting in the interests of society tend to actually just be acting in the interests of a very small elite. And my argument in the book is that the crisis is actually accelerating these trends, is actually generating a fusion almost, or is deepening this fusion between private and public power. So both because we have these really big, powerful monopolies that have a huge impact on our political system, and also because our political system is, again, really being geared towards the interests of the private sector. Now, a lot of the work I've done has been focusing on how that's reflected in terms of central banking, the changing nature of central banking. When you have, for central banks, asset prices as effectively a target, maintaining asset prices as a target of policy, that is a really significant political shift in the nature of central banking. And really does suggest actually that policy, the monetary policy, is being used to support the interests of the wealthy. But also much more generally, we have these very, very close links that have become very evident between the private and public sector over the course of the pandemic. It kind of puts paid to the idea, whether you're talking about monopoly power, increasing amounts of corporate welfare, it puts paid to the idea of kind of free market capitalism, and suggests we are living in a pretty kind of centralized, technocratic, what I call planned capitalism. So rather than having this distinction between free market capitalism on the one hand and planned socialism on the other, I think that within the system that we have right now, you can see a significant amount of centralized planning, whether that's within big monopolies, financial institutions, or states. And the problem that creates is a problem of legitimacy, because if we have a large number of very, very important decisions being taken by a very small number of people, and none of which are really getting to the core of these challenges that we face, like I mentioned at the beginning of this talk, then you start to really see what we're seeing at the moment, which is a breakdown in trust in democracy, a breakdown of the legitimacy of our elites, and also just an inability to tackle any of these problems that we need to tackle, particularly climate breakdown. So what I argue for in my next book, which is on this whole idea of planned capitalism, is that we really need to try and democratize the economy. We need to try and democratize decision-making processes, and really, take a lot of these quite secretive policy decisions that are made behind closed doors, take them out into the open, facilitate public debate, and really start to ask questions about where we want to go next as a society, rather than saying, oh, we'll leave it up to the free market, which we're not doing anyway, because, we don't really have a free market. We should accept that. We should really be saying we have decisions to make about what is produced, about how resources are allocated, about what we're investing in. Why don't we take those decisions collectively, democratically, and with a view to promoting equality, sustainability, and actually making our planet livable over the long run? And I think I've been talking for almost exactly 20 minutes now, so I will stop and open up if anyone has any questions. Thank you very much.
Fabulous. And you were galloping through the whole world of economy and capitalism and policy making. It was a real pleasure to see your brilliant mind sparkle across the ether. Thank you so much. We have a few questions before I go into them. I might want to ask a question myself, because what you described, democratized decision making, of course, reminds me of my own small country, Switzerland. And now that our both wonderful countries are outside of the European Union and have the best universities in the world, you have 4, we have 1. The Americans have 5, but the Europeans, according to statistics, have none. How do you see that influencing how one could build a better world, if that's the term I should be asking?
Yeah, well, I mean, you know, we haven't really talked at all about Europe and the challenges of facing the European Union, and particularly the Eurozone. But I think that Europe has yet really to face up to some of the big existential problems that it is facing and will continue to face over the course of the next several years. So there are so many to go through. But I mean, I think particularly there is this challenge within the Eurozone of how to manage the relationship between the periphery and the core, how to manage the relationship between the south and the center. The Germans obviously are very, very focused on maintaining this quite severe form of permanent austerity, what they refer to as Schwarze Null or Black Zero, and really kind of pushing that out into the rest of the European Union as well. So we had this small relatively small package that was supposed to, the kind of European Green Deal, supposed to alleviate some of those differences in productivity between North and South, and get some way towards decarbonisation. And yet all of those problems that we were seeing with Italian banks, with Greek sovereign debt in Ireland, and all of these places, they're still very, very live. And it doesn't look as though they're going to get any better. And in fact, they could continue to get worse. There is no political solution as yet to that really big existential problem. And even before COVID-19, there was some speculation that what we would be ultimately start to see is the emergence of a kind of two-speed Europe. So the kind of splitting off between the North and the South, and perhaps even the creation of 2 different currencies. It's not quite clear yet what's going to happen there. A lot is really being determined now by the European Central Bank. And that is creating some challenges within Germany. Obviously, there's been this challenge to what the ECB has been doing is unconstitutional, because it's been buying sovereign debt, which the Germans say is, inflationary, and given historical experience, are not particularly fans of anything that could be perceived as inflationary. So there's a big challenge there. But actually, the bigger challenge for Europe is what it's going to do in a world divided between America and China. And you see some of the challenges that is creating emerging already. So, for example, the French and the Germans are very keen to kind of be a bit more lax when it comes to competition policy, so that you can get the emergence of some big, powerful European companies, kind of oligopolies or monopolies, that are able to challenge Chinese state-owned corporations. A good example of this is in railways, right? The Chinese infrastructure companies are very, very big, very, very powerful. They're competing with European firms like Siemens, for example. And there was an attempted merger between Siemens and Alstom. And there was some pressure just to allow that to go through, even though it would have a negative impact on competition. And that's an interesting challenge for Europe to think about over the long term. Then you have all these divides with the US over the tech monopolies, and the EU's treatment of the tech monopolies, which has been to kind of try and promote competition. But that's obviously created some divides with the US. So all of these challenges mean that, none of which have been resolved, mean that Europe is going to continue to be mired in conflict for a long time, from, even after the pandemic. And to be honest, I think that those states that are outside of the European Union and therefore able to perhaps, democratically resolve some of these challenges themselves by basically, putting these questions to the electorate rather than having a European bureaucracy decide how to manage them, will potentially be in a better position.
Thank you. And I understood that you say there is this monolithic large companies which are centers of gravity and pull the whole political system towards their interests. If I can rephrase that in my own words.
That's right.
And how would you see a way how we could break this tie or how make this, because sometimes transparency makes things clear, and I think at the moment you mentioned there's intransparency, and what's the recipe, maybe in 1 or 2 sentences, how one could make this more visible to the electorate?
Yeah, I think it's a really big question. So take, for example, central banking, which I've talked a lot about because I think it's a really increasingly important area of economics and politics. Most people don't really know how monetary policy works. At best, they might know that the central bank sets interest rates and that maybe affects the amount that they pay on their mortgage. Lots of people have no idea about asset purchase, about quantitative easing, about the impact that that's having on, their pensions or whatever else. So I think we need a lot of education about how the economy works. And actually, we don't really have that. I think often because it's not in the interests of politicians for people to really understand what's going on so that they can challenge it. I think we need a lot of education about the impact of these policies. And also, I think we need to open up the mechanisms through which these decisions are made to public scrutiny, as you were saying. So have a much more transparent system, and one for which people can be held accountable. So if you could have kind of a citizen panel or a citizen jury, for example, that was saying to central bankers, right, so why did you take this decision? Or what has the impact of this decision been on all of these different variables, on the environment, on inequality? I think that would go some way to kind of addressing some of these issues.
Thank you so much. We have a couple of questions now in the meantime. Thank you for those. I will ask Grace to kindly reply to those, maybe in not taking too much time, so we can
Sorry, I get overexcited when I get a good question and then I just speak for ages, so I'll try and keep it brief.
Everything is fine. I just try to give everybody a chance, and also, of course, just for reference, if you get these questions afterwards, and if somebody wasn't replied to properly, you can still take contact with each other one-on-one. Yeah. So the first question which I would like to pose is asked by Christopher Gliedel. He thanks you for what you did so far. How do you see the effects of climate change on asset devaluation over time? Do you see it as another crash in waiting?
Good question. So do we have a carbon bubble? And if so, will it burst? It's a difficult question, actually. And I think, a lot depends on policy. I think had we not had some guidance from central banks and from treasuries that, they would be moving away from these kinds of assets, that there would be pressure for investors to move away from these kinds of assets, and that, over the long run, these assets would no longer basically be able to exist in their current form. So let's say, shares in ExxonMobil, right? That has already created something of a correction. So we've already seen, I think it was last year, that the world's biggest renewable energy company got a higher valuation than ExxonMobil. So that's already a pretty big shift, but it's clearly not happening fast enough. And I think that is obvious in two ways, both in terms of the valuation of some of these fossil fuel companies and also in terms of the priorities of their boards. So we're not seeing them move quickly enough into renewables and away from fossil fuels. And partly that's because in the US, at least, these companies are still getting subsidies from the state. So ExxonMobil, for example, is still getting subsidies from the American state to continue to exist. And again, I think that speaks to just the extraordinary power of these fossil fuel companies within our political system. So we really need to break that link if we're going to see real progress on this. I don't think, actually, to answer your question, that we're going to see a big bursting of the carbon bubble, I think it will be a slow devaluation in these companies.
Small change. The next question is asked by Mike Riddell. Isn't more community the investment answer to widening inequality, climate breakdown, and low productivity?
What did he say? Sorry, more community?
Yeah, isn't more community the investment answer to widening inequality, climate breakdown, and low productivity?
I'm struggling to see what he means there by community. So does he, I suppose, what kind of more coordination between investors on those issues? I'm sorry, I'm just not 100% sure what he means there by community. Can you just ask him?
Yeah, he's listening. He will probably reply to that. I think what I would interpret is probably like if you tie investors up in groups, like in a mutual fund.
Right. I see. Yeah. Okay. Got you. So kind of coordination.
Yeah, exactly. And I think that would probably be like voting with your feet in the ESG sector, where you say companies which are in fossil sector we don't invest in, and therefore theoretically yields should go up, dividend yields should go up, and all that.
Yeah, I mean, I think actually, if anything, the problem that we have at the moment is maybe a bit too much community, in the sense that we have a few massive asset managers and their portfolios are effectively determined just by what's in the big indexes. So if ExxonMobil is in an index that is being tracked by a BlackRock ETF, it's going to get investment, right? I mean, obviously, we're hearing a lot from the heads of these firms that they're saying, no, we're going to take climate into account when we're making these decisions. But ultimately, if, you know, for example, as happened last year when the price of crude hit the floor, if investors there see an opportunity, they have a fiduciary responsibility to take advantage of that opportunity. So if it means investing in oil is going to get you returns that you're then going to be able to pass on to your agents, then you have to do that. So I think, you know, there needs to be a regulatory answer to this question, really. Is how do we balance the fiduciary responsibility of asset managers with the need to really kind of push for sustainability? And I don't think ESG is a good, I don't think anyone really thinks that ESG has been a good response to that. It needs to be much kind of sharper, I think, and yeah, more firm.
It's much too intransparent as well. Yeah. Mark Cook asks the next question, and he says, does Grace think the pandemic will allow China under the Belt and Road Initiative to take an ever bigger presence in Europe now that they have bought ports in Greece, Spain, and Italy?
This is an absolutely fascinating question, and I won't be able to answer it all in the time that I have allotted. But I mean, in short, yes, this is really going to be China's crisis. Now, 2008 was to an extent China's crisis. I mean, you saw that massive stimulus package introduced after the financial crisis in China, which really consolidated the shift from a kind of export-led growth model to an investment-led growth model. The trouble that you have now is that a lot of that domestic investment has been pushed into places like, you know, the famous ghost cities or areas where it's not particularly efficient. You've had just an astonishing amount of infrastructure investment in China that has really brought it up to date with, you know, many parts of the West, and a lot of it actually quite green investment. So China has something like 96% of the world's electric buses, and that's all to do with the investment that's been undertaken since the financial crisis. But at this point, and I think the reason that we're starting to see a big step up in the Belt and Road Initiative is that the opportunities for investing in China and the outlets for that huge stock of savings that exists within China domestically are drying up. So they're going to have to start exporting more capital, whether that means, you know, doing so in Africa or through the Belt and Road Initiative. The questions I think I have around the Belt and Road Initiative are all to do with transparency and governance. So for parts of it that have been completed, like or on the way to be completed, like CPAC, the China-Pakistan corridor, there have been all sorts of issues around corruption, around the Chinese basically saying, right, we're creating, say, you know, this rail network or this utilities project. If you can't manage it properly, we're just going to keep hold of it, which creates all these problems around kind of governance and democracy in parts of the global south, and also around the management of debt that is accrued. So we've seen actually China being relatively lenient over the course of the pandemic in terms of states repaying their debts to China. And it's obviously in China's interests for that to continue, because they don't want a load of countries to default, of course. They don't want these projects to stop. But we don't know what's going to happen to that over the long run. And in terms of Europe, I mean, this comes back to what I was saying in that answer to Ariel's question, which is Europe really, the ball is in Europe's court here. The Chinese investment is not going to stop. The question is, what is the response going to be? And if the European Union cannot offer states in the south, increases in productivity and growth, then it makes sense that they will go to China for greater levels of investment.
Thank you for this. We still have a number of questions left, if you like. Rod Dowler asks, Grace, do you see a distinction between the extractive rentier capitalist, i.e. the finance sector, and the creative innovative capitalist, such as much as the tech sector, including Apple and Tesla? Yeah.
Well, I mean, it's an interesting question. There certainly is a distinction in terms of the way that they're, generating their profits. So, I mean, in the UK, for example, you have quite a big what's called a FIRE sector, so finance, insurance, and real estate. And obviously, we know the problems that sector could create if allowed to grow without any constraints, because we saw it in the wake of the 2008 financial crisis. And really, something like finance or real estate, where a lot of the profits are effectively just transfers. You're not creating any new wealth. You're simply transferring wealth from a renter or a debtor to a creditor. That is obviously problematic. But the two examples you use there, I think, are interesting, because there's a very strong argument that actually a company like Apple is also a rentier. And it's a rentier in the sense that it's a semi-monopoly or an oligopoly, or it's a company with a huge amount of market power, and is therefore able to extract its own forms of transfers, of unproductive transfers from consumers, suppliers, and various other economic actors, without necessarily investing that productively. Apple is, again, an interesting case because it's not quite on the level of something like a Google or a Facebook, but there are still dynamics at play there where you look at what Apple is doing and you think, okay, this company is in certain sectors not a monopoly, but they have a substantial amount of market power. And that means that they're able to kind of shape what goes on, for example, throughout its supply chain. So, if you look at Apple's supply chain, you have workers in Foxconn factories being really quite drastically mistreated. And you can say, well, that's not Apple's responsibility. But ultimately it is, because it's a monopsonist. It's one of the biggest single buyers of a lot of these goods and services. And that's obviously creating a lot of problems in itself. And the other big problem with all of these big tech companies is actually, they're famed for being really innovative. But actually, if you look at what they're doing at the moment, they're not really doing that much innovation themselves. Well, a lot of their spending, a lot of their innovation budget is spent on buying up smaller companies that may have actually, if they'd remained independent, been much more innovative than when they're absorbed into these big tech giants. So yeah, I mean, I don't think it's quite just as simple as kind of good tech companies, bad finance companies. In many ways, actually, they're acting quite similarly, increasingly, especially over the last 10 years.
Behind it is always human nature, I suppose. The next question is asked by Hugh Purser. He actually has two questions. I'll just take one. Democratization would normally imply a weakening of the control of the center, the state, central banks, etc. Is this, or how realistic is this?
Well, I mean, yeah, this is a good question. So I think this kind of comes back to the perspective that I kind of analyze capitalism from, which is a Marxist perspective. And that perspective really centers not the actions of states really, or necessarily the actions of individual businesses, but really the balance of power within society. And so my argument is that, when you have a society in which a significant amount of power is concentrated within the hands of, say, in the UK, the finance and real estate sector, you're going to end up getting policy outcomes that favor financiers, landlords, etc. And this is really what we've seen over the last 10 years. So shifting that, moving towards a more democratic, more sustainable model requires creating something of a rebalancing of power. And, you know, in, for example, the social market economies and some of the European economies, what you see is that the labour movement has a good deal more influence in terms of setting policy. You see that there's often less concentration in terms of corporate concentration. So often there's a kind of much more diffuse corporate class, maybe represented by kind of business associations. And you often also have a much stronger voice for civil society. So civil society groups, you know, organising and representing their interests directly to the state. Whereas in countries like the US and the UK, very, very weak labour movements, almost kind of, you know, non-existent labour movements in some cases, and often not that strong civil society organisations that can really push for change in Congress, certainly not compared to the very strongly organised power of corporations when it comes to setting policy. So if we're going to really see a shift, it will come from, I think, the bottom up.
Excellent. We have a question, thank you. We have a question by Donald McRae. He says, have you got any examples of successful, effective, democratic economic management or policy making?
Yeah, so I think the most interesting ones are often at the kind of subnational level. So I would really encourage people to actually go and check out the work of something called the Democracy Collaborative. And they do lots of work with municipal and state governments in particularly the US and the UK, some European cities as well, looking at how they can democratize policymaking. So in Barcelona, for example, they've experimented with a kind of digital democratic policymaking process whereby you know, the municipal government will kind of subject their decision making to online votes. In parts of Brazil, you have something called participatory budgeting that's taking place. So you get a kind of representative sample of citizens in a local area. You bring them in and you say, what should we be spending our money on? How should we set this budget? And that functions both to kind of educate people and to really kind of distribute power more effectively. Even in the UK, actually, in Preston, we have this idea of community wealth building, whereby the local council has, rather than kind of outsourcing all the services to these big, you know, outsourcing companies like Capita and Serco, has started to insource a lot of their services and provide preferential access to procurement to companies that are local, that are sustainable, that have good relationships with their workers, often that are cooperatives. And so you start to see much more kind of wealth and power being kept locally. So I think a lot of those kind of local examples really show what can be done. And they also show the importance, I think, of decentralization. So the UK is one of the most centralized economies in Europe politically. Only 5% of revenues are raised outside of Westminster. So in the UK, I think one of the biggest opportunities for us is really thinking about how to do decentralization and hand power down to local areas.
Very interesting to hear that. The last question, I think, because time is soon up, is by Oliver Knight. And Oliver Knight says to you, you sensibly talk about more open public debate. How do we allow and encourage this to happen with polarized, instant and short-term focused media?
That is an excellent question. And you know what, I really think that there is no substitute for you know, face-to-face interaction. Now, that doesn't obviously mean kind of getting everyone in society in a kind of room together and getting them to hash it out. But I think things like, you know, citizens' assemblies, for example, where you get a representative sample of people throughout society and you get them in a room and you maybe film the process by which, you know, you get very right-wing people with very left-wing people with, you know, liberal people working together to talk about their ideas and their interests. And more often than not, you see commonalities emerge in their priorities, and it can really work to kind of de-radicalize, particularly some of those people on the far right. You know, think of something like the anti-vaxxer movement, right? It's not going to be enough just to kind of vilify these people and say, oh, they're wrong, they're stupid, whatever. You have to figure out a way of engaging them in some form of debate. And I think partly that means, you know, trying to do open forums where people can kind of debate. It also means making sure that you have I think kind of interesting and novel types of programming, because you're right, the media at the moment really prioritizes getting people to fight with each other. I know, because I do that a lot in the media. They bring me out and they say, fight with this guy. And I'm like, okay, fine. But actually, if we had a kind of more conciliatory and open way of expressing and debating ideas, I think that would probably be very useful as well.
Thank you so much, dear Grace. I enjoyed that greatly. I will thank you at the end again. We are coming close to our 45 minutes mark, so it's unfortunately my role to close this wonderful session, which was very interesting for me. And I thank all those who contributed with questions for their wonderful questions, which I thought showed how much we engage with you, Grace. I would like also to thank the sponsors again. Without them, which are now on the screen, all of this hadn't been happening. So thank you very much for the sponsors. Then I would like to ask Peter to put up the slide with the future events, if we find that. If we don't find that, then yeah, here it is. So this is coming up in the next 4 weeks. I hope you can join us again for another session. And now it falls to me to thank Grace again for an enormously enjoyable, if that's English, discussion which we had, because not only you command so much know-how and knowledge about the world, you are also fun to talk to and listen to. Thank you so much.
Thank
I wish you all the best in the future. And thank you again, everybody listening today. And please join us again for the next time. Thank you. Bye-bye.
Thank you very much. Bye-bye.
Thank you. Bye.